the last point is actually this thing called market lag. We actually made some predictions back in 2017, 2019, 2020, 2021. Like, we made some predictions on market lag. What is market lag?
So I think market lag is basically something that we have been doing, right? Just that there wasn't a real term to it, right? Yeah. So that's where we come up market lag, right? But really think about it. Why did we even invest in industrial property in the first place? Because if the average rental yield, you think about it, for industrial property across the years was at 5%, right? Across the years, right? And because of the consistent drop in terms of prices, but yet rental has been staying the same or still growing, the rental yield typically then hits 6%. Right? Now, that being said, because market sees that price will be dropping, it's not uncommon that the majority of people will not dare to enter into industrial space for fear that it might keep going downward. Right?
So, when it comes to industrial, there was an era when business owners who are doing well, we don't talk about new business owners, do not understand that buying will cost them little to no money renting their space. Does it make sense? So the numbers was very prevailing out there. But whether they do the math or is there a proper advisor that guide them or not is subjective. So there was a big open market, and even when we were started, we were not even doing classes. We were speaking to some business owner and helping them to buy industrial property. They were shocked that why the hell are they not buying and they are renting at a premium, and that would have cost them zero money or even make profits owning on the unit they're doing. So the market always have a lag because people don't have absolute information. They do not do absolute math as well. So during those periods, we went to buy and then ran to those unwoke entrepreneurs who are renting. That's the market. And suddenly now it catch on. If you realize, a lot of people realize that renting industrial might not work very well. So a lot of business owners are now buying industrial property because they know rental are so high, it doesn't make sense. So that is the lag we are talking about here. When the rental yield is so high to a business owner, they don't see rental yield because they are not a real estate investor. And that creates an opportunity for us to enter during the industrial space.
I mean, you really look into the numbers, right? You really research landed property data. Landed was one of the lowest or lousiest performing asset actually prior to 2019.
Rental was bad.
Rental is bad. Growth is so-so. Right? And then of course you talk about investing in OCR and all that. I mean the rate of return was much better, right? But of course then that's where finding out the key indicators that what we think, all right, and we are confident in to really drive up this price point, which in our scenario was understanding that if all new launches were launching 4-bedroom, which is the same target market as landed property, was willing to pay 2.8 million to even 3 million for a 4-bedroom condominium, where across the street, just 2 minutes drive down the road, you're able to get a terrace home rebuilt up at also the same price point, then it doesn't make sense to me. All right, so I think that at the point of time, I made a very bold prediction while in so-called landed wasn't doing too well. I made a bold prediction and tell everyone, hey, you can go into landed, go into landed. I don't care what you sell, you go into landed, right? And I'm just glad that some of you guys managed to push through to actually enter into landed property at the same period as us.
We had quite a few community members who entered into the landed space and now minimally sitting on 1M profits.
Yeah. So you look at a broad market conversation. It says 6% capital appreciation. I heard before, 4%, 8%, right? Those are broad market. So the easiest level that you should be looking at, even for global market, is this. So let me explain. The first level is called business, right? So adding travel, tourism, business. Business have business risk, yes? The second level is called cash flow. The problem with cash flow is it's so seductive, people forget the risk exposure to the amount of positive cash flow. That's why I want to put a very big caution here, right? That you want to have sublet with smart risk exposure, right? So that's second level. And the easiest, right, is to look at disproportionate capital appreciation. What do I mean? In no numbers, right, you can quantify that in 6 months to 9 months, Sean will have a capital appreciation of $2 million. It's just impossible to look at broad market to come up with such prediction, right? So hence, if you want to make tremendous wealth in a global market, right, you want to focus on lag. When the market haven't catch up with that disparity, and overnight when they catch up, the price can shoot up really fast, and that's what we call priced in after that, right? So right now, landed is already priced in. That's why you will not see a significant jump in most areas as well.